You saw the title of the video, you know exactly what it's about. This is the top 6 Vanguard index funds you can buy. At number 6 is VTIAX, or the Vanguard Total International Stock Index Fund. This fund seeks to track the performance of the FTSE Global All Cap X US Index, which is an index designed to measure the stock market performance around the world, excluding the United States. I specifically chose to add this fund to the list because of its international exposure. For the majority of investors, having some international exposure in your portfolio will help to add diversification, especially for passive investors. That is, if you are investing primarily in passive index funds or passive ETFs, which is what most of you are probably investing in without actually even realizing it. This Vanguard fund currently holds about 7,532 international stocks, with top holdings in Taiwan Semiconductor, Nestle, Samsung, and a few others that you may or may not recognize. The average 10-year return currently sits at a 6.61%, which means $10,000 invested 10 years ago would be worth close to $19,000 today. Again, I really want to emphasize that this fund is not designed to act as a core position within your portfolio. In other words, in my opinion, it definitely should not make up over 10 to 15% of your overall portfolio. In terms of cost, this index fund has an expense ratio of 0.11%, which means you'll pay $11 per year on $10,000 invested. One very important thing that I want to point out about pretty much all of Vanguard's index funds is that most of them do have a $3,000 minimum investment requirement, and this fund is no exception. In order to invest your money, you'll need at least $3,000. However, there is a solution. Most Vanguard index funds are also available as ETFs or exchange traded funds. For this fund specifically, the ETF equivalent is VXUS, and this ETF of course doesn't have any minimum investment requirements, just the price of one ETF, which is currently trading for about $61. You can pause the video here to take a closer look at this, but we're gonna keep on moving on. Also, I've gotten a lot of questions from you guys asking me to explain the difference between an index fund and an ETF. And so at the end of this video, I'm gonna briefly explain the difference between the two and which one you should choose when investing. Next up is VMGAX, or the Vanguard Mega Cap Growth Index Fund. This index fund seeks to track the performance of the CRSP US Mega Cap Growth Index, an index that measures the investment return of the largest capitalization growth stocks in the US. Now, this is a very niche index fund that focuses on a very small portion of the US stock market. Currently holding 102 stocks with top holdings in, well, every one of the largest companies in the world that you'll definitely recognize. It's no wonder then that this index fund has given a 10-year return of 18.09%. This means $10,000 invested 10 years ago would be worth well over $57,000 today. If you're looking to maximize diversification and limit your portfolio's volatility as much as possible, then this index fund should not be a core holding in your portfolio, but instead a non-core holding. If you don't know what the difference between the two are, then I'm going to explain it briefly in just a few minutes here. Surprisingly, this index fund has a very low expense ratio. At 0.06%, you'll only have to pay $6 per year on $10,000 invested. But of course, Vanguard can't just go and give you access to this fund that easy. They will require a minimum deposit of $5,000 to begin investing. But like with every fund on this list, this index fund is also available as an ETF. And that ETF is MGK, or the Vanguard Mega Cap Growth ETF. It's an exact replica of VMGAX, except as an ETF. At number 4 is VDIGX, or the Vanguard Dividend Growth Fund. The benchmark for this actively managed fund is the S&P US Dividend Growers Index, and is designed to measure the performance of US companies that have followed a policy of consistently increasing dividends every year for at least 10 consecutive years. And yes, that was not a mistake. You heard me right. This fund is indeed actively managed. This is different from most of the passively managed funds that most of you are probably investing in. The difference is simple. With an actively managed fund, a fund manager or a management team makes day-to-day decisions about how to invest the fund's money. Their main objective is to attempt to beat the returns of a market index. In contrast, a passively managed fund simply follows a market index, such as the S&P 500 or the Dow Jones Industrial Average. Passive funds do not have management teams making daily investment decisions. These two different fund styles do have their pros and cons that I'm not going to discuss in this video here, but just understand that generally speaking, a passively managed fund will be a lot cheaper to own and historically have outperformed actively managed funds. Now, this fund has a very small portfolio compared to most funds, holding only 42 stocks with top holdings in TJX, Colgate, J&J, Coke, and a few others. As you can probably tell from the top holdings, this fund is only investing in companies that have a proven dividend history. And so obviously you're not going to see stocks like Amazon, Tesla, and Google because these companies don't pay a dividend. In terms of performance, this fund has a 10-year return of 13.94%, which means $10,000 invested 10 years ago would have grown to about $38,000 today. Definitely still impressive growth, especially from an index fund that focuses primarily on dividend-paying stocks instead of growth stocks. Now, because this index index fund is actively managed, it is a little bit more expensive with an expense ratio of 0.26%. You can expect to pay $26 per year on $10,000 invested. Now, this fund does have the $3,000 minimum investment requirement, but there are some really great cheap ETF alternatives. Although Vanguard doesn't list an exact ETF equivalent to this index fund, I do believe that both VIG and VYM are amazing ETF alternatives. Again, pause the video here to see these details, but let's keep moving on. Halfway through the list now, at number 3 is VIGAX, or the Vanguard Growth Index Fund. This fund seeks to track the performance of the CRSP US Large Cap Growth Index, a benchmark representing growth stocks of large US companies. And so this index fund is not only hyper-focused on growth stocks, but large cap growth stocks. This presents a problem in that this index fund is not very diversified. But ideally, you would combine this fund with another index fund whose holdings include not only large cap stocks, but mid and small cap stocks as well. And further down the list, there will be some index funds that give you that type of exposure, so make sure you keep on watching. Of the 267 stocks that this index fund holds, its top holdings include companies like Apple, Microsoft, Google, Amazon, and so forth. And because this fund focuses on growth, it makes sense that the average 10-year return is currently sitting at 17.41%, which means $10,000 invested 10 years ago would be worth close to $55,000 today. The expense ratio for this fund is one of the lowest on the list so far, coming in at 0.05%. You'll only have to pay $5 per year on $10,000 invested. And yes, unfortunately, this index fund also has the $3,000 minimum investment requirement, but an identical ETF alternative is VUG, or the Vanguard Growth ETF. And so if you can't afford that $3,000 minimum investment, this is a perfect alternative. At number 2 is VTIAX, or the Vanguard 500 Index Fund. This fund offers exposure to the S&P 500 index, which is an index that tracks the performance of 500 of the largest companies in the US stock market. VTIAX is arguably one of the best buy and hold investments that you can include within your portfolio if you want a fund that uses the S&P 500 as its benchmark, like this one. Because it invests in the S&P 500, it should come to no surprise that this fund holds about 500 stocks, with top holdings in Apple, Microsoft, Google, and many other top US companies. This fund has returned an average of 15.39% annually over the past decade, and so $10,000 invested 10 years ago would have grown to about $44,000 today. This index fund has one of the lowest expense ratios on the list at 0.04%. You'll only have to pay $4 per year on $10,000 invested. And to avoid that $3,000 minimum investment requirement, you can simply invest in VOO, which is the ETF equivalent, which also has a smaller expense ratio. Now, most investors who are using this index fund within their portfolio are using it as a core holding. Core holdings are the central investments of any long-term portfolio, and they usually make up a vast majority of the portfolio's investment. It is absolutely critical that you have a core holding in your portfolio that has a history of reliable growth and consistent returns. Going back to the example from earlier, if we take a look at number 6 on the list, VTIAX, you would not want to include that index fund as a core holding within your portfolio, because that fund does not have reliable growth and consistent returns when compared to other better funds. But your main core holding should always be something with consistent growth and reliability, such as an S&P 500 fund or something else similar. And finally, the number 1 index fund on this list is VTSAX, or the Vanguard Total Stock Market Index Fund. VTSAX seeks to track the performance of the CRSP US Total Stock Market Index, which is an index that represents virtually the entire US stock market, including large, mid, small, and micro cap stocks. And with an average 10-year return of 15%, $10,000 invested 10 years ago would be worth about $43,000 today. Now, you may be thinking to yourself right now, Joshua, why is this index fund number 1 on the list if the past returns are not as high as some of the others that you mentioned on this list? And it has a lot to do with the fact that this fund still gives a really good return while also being diversified across multiple sectors and market caps. For example, this fund currently holds about 4,139 stocks. That's 4 times the number of stocks held in the previous index fund, with top holdings in Apple, Microsoft, Google, etc. The expense ratio is also very small for this index fund at 0.04%. You only have to pay $4 per year on $10,000 invested. And finally, if you want to invest in this fund without that $3,000 requirement, you can simply invest in the ETF equivalent, which is VTI, or the Vanguard Total Stock Market ETF. Now, I'd like to transition and talk about the difference between an index fund and an ETF ETF and which one is right for you. On the surface, the two are virtually identical. Both are types of investment funds that allow you to invest in thousands of different stocks and bonds at once. And what you'll notice is that with a broker like Vanguard, for example, all throughout the video, I gave you ETF equivalents to the index funds that I presented. And the ETF equivalent, for the most part, always performs identically to the index fund. For example, here I am on my computer, and if I go to the Vanguard website and I look up the fund profile for VTSAX, which is the #1 index fund on this list, I click up here on price and performance, then scroll down to the performance chart. There's going to be an option right here to add a fund or ETF. And this will essentially let us compare two different funds side by side to see how they perform against each other. And so if I type in VTI, which is the ETF equivalent of VTSAX, add it, what just happened? Do you notice anything? We are comparing two different funds here, okay? VTSAX, the index fund, and then VTI, which is the ETF equivalent of VTSAX. Well, what you'll notice is that these two funds literally have the same exact performance. The performance is so identical that you can't even see the two different lines because they match up exactly. Although these two investments do not share the same name, they are basically identical with a couple really small differences. The first major difference between an index fund and ETF is how exactly you invest in them. What I mean by that is, say for example, you wanted to invest in any of the Vanguard index funds that we talked about in the video today. Well, the only way you're going to be able to do that is by opening up a Vanguard brokerage account. And so if you want to invest in a Vanguard index fund, then you need a Vanguard brokerage account. Now, technically, you still can buy Vanguard index funds in an outside broker such as Fidelity. But in order to do that, you'll first need to pay a fee of up to $75 per trade, which is just absurd. Don't do that. So, index funds are broker specific. Okay. On the other hand, ETFs are not broker specific. If I wanted to invest in a Vanguard ETF such as VTI, but I had a Robinhood account, I can still buy that ETF in Robinhood. And that's because unlike index funds, ETFs trade on the stock market exactly like stocks. The same exact way that you can go to your broker, open up the trading window, type in Apple, and buy a share of Apple, you can do the exact same thing with ETFs. I can still buy this Vanguard ETF within my Fidelity account because this ETF trades on the stock market. This also means that ETFs can be bought and sold throughout the day as long as the stock market is open. On the other hand, index funds can only be traded once per day, and that's at the end of the day after the market closes at 4 p.m. Now, you can technically initiate a trade throughout the day with an index fund, but that trade will not be executed until 4 p.m. Some other small differences between ETFs and index funds can be seen here. For example, although it's negligible, ETFs tend to be a little bit more tax efficient than index funds, especially outside of a tax-advantaged retirement account such as a Roth IRA. Overall, though, you honestly cannot go wrong with either of these investments. Now, I personally invest in ETFs because I enjoy the flexibility of being able to buy and sell them throughout the day, but that's just me. Okay, that's all I've got for you in today's video, guys. I appreciate you so much. You're amazing, and as always, I will see you again very soon. Take care.